Hey, you. Ever looked at financing a commercial property and just felt completely overwhelmed, like you're reading another language?
Oh, absolutely. It's a major step. And honestly, getting the right financing, that's often the make or break moment for the whole deal.
Totally. So in this deep dive, we're really zeroing in on how to get the best possible financing for your commercial real estate plans. We've gathered insights from, well, all over,
Yeah, we've got stuff from banks.com, JP Morgan, advice from platforms like fundingoptions.com.
and experiences from actual business owners via biz2credit.com, plus lender reviews from NerdWallet. It's quite a mix.
It is, and it's interesting to see where they agree, even coming from different places.
Right. Our mission here is pretty simple. Cut through the noise, pull out the crucial bits so you understand your options, feel confident, and don't get bogged down. Your shortcut to getting informed, basically.
Sounds good.
Okay, so let's dive right in. Where do you even start? What are the main financing options people should know about?
Well, the first place most people think of is conventional loans from banks, credit
The
unions.
traditional route.
Exactly. And sources like banks.com, Viz2Credit, mention they often have good rates. The thing is, though, you usually need a strong credit history, a solid business behind you.
Okay, so best for businesses that are already pretty established, have good financials.
That's generally the idea, yeah. If you've got that track record, it's often a great place to start looking.
But what if you're, say, a newer business? Or maybe your credit isn't quite stellar yet. That's where SBA loans fit in, right?
Precisely. The Small Business Administration, the SBA, they back loans to help businesses exactly like that. Pretty much all our sources, banks.com, Biz2Credit, NerdWallet, they all point to these.
And there are different types for real estate.
Yeah,
Yeah.
mainly the 7A and the 504 loans when you're talking property. They're built for slightly different needs.
Okay, let's break those down a bit. The 7A sounds pretty versatile.
It really is. You can borrow up to $5 million, which is significant, and the repayment terms. They can stretch out, sometimes up to 25 years.
Wow, okay.
Plus, a lower down payment is often possible, and you can use the money for more than just the building, working capital, equipment, stuff like that.
But there's a catch, I assume.
Well, not so much a catch, but you definitely need to show your business is healthy, that you can handle the debt. Lenders need that reassurance.
Right, makes sense. So flexible, but you got to prove you're a good bet.
Yeah,
And the 504, that seems more targeted at the property itself.
exactly. The SBA 504 is specifically for buying commercial real estate or maybe big improvements or even major equipment.
How does that one work? Is it just one lender?
It's actually a bit different. It usually involves a bank covering part of it and then a certified development company or CDC that's a nonprofit focused on economic growth covering another chunk.
Interesting structure. What are the advantages there?
Often a really low down payment, sometimes around just 10%. And the interest rates tend to be lower too. The main condition, though, is the property has to be primarily for your own business operations, not just an investment property you rent out.
Got it. So if you need a place to run your business from, the 504 looks really appealing. Okay, shifting gears.
Mhm.
What if you need money fast? Like bridging a gap?
That's exactly what bridge loans are for. They're short term,
Wow.
designed to, well, bridge a gap until your long term financing comes through, or maybe until you sell another property you own.
Useful for quick moves then.
Definitely. If timing is critical or you're just waiting on other funds, they can be a lifesaver. But, and this is important, they usually come with higher interest rates, speed costs.
Yeah, that seems to be a common theme. Okay, what about hard money loans? They sound different.
They are quite different. Hard money usually comes from private investors or specialized lending companies, not your typical bank.
And how do they decide? Is it less about credit score?
Often, yes. They tend to focus more on the value of the property itself, the collateral, rather than scrutinizing your credit history quite as much.
So faster approval, maybe. Good for someone with less than perfect credit.
Potentially, yes. Approval can be quicker, and it can be an option if your credit score isn't top tier or you just need cash now. But again, you'll almost certainly pay a higher interest rate for that speed and flexibility.
Right, the trade-off again. Okay, and what if I'm not buying, but building? Starting from scratch.
Then you're looking at construction loans. These are specifically for building projects, covers the land, materials, labor, all that.
Are they long-term?
Usually, no. They're typically short term, just for the construction phase. Once the building's finished, you'd normally refinance that into a standard long-term commercial mortgage.
Gotcha. Specialized tool for a specific job. Now, everything's online these days. How do online lenders fit into commercial real estate?
They're definitely a growing part of the picture. Their big selling point is often speed. Some promise funding in just days, which can be incredibly useful.
But I sense another but coming.
You sense correctly. The but is, again, often the interest rates. They might be higher than what a traditional bank offers. So it's a faster option, maybe easier access, but you really have to weigh the cost.
Speed versus cost.
hmm
Okay. One more option, seller financing. That's where the seller acts like the bank.
That's it, exactly. The person selling you the property provides the loan, or at least part of it.
Why would someone do that or choose that?
It can mean more flexible terms, potentially. You're negotiating directly, and it can speed up the closing. It's definitely an option if getting a traditional loan is proving tricky.
Okay, wow. That's quite a landscape of options. It really helps to see them laid out. You mentioned real-world examples.
Yeah, there was a great one about a bakery owner. Got turned down by a bank initially, just couldn't meet the standard requirements.
Ah, okay, so what happened?
They ended up getting an SBA 7A loan. The lower down payment and the longer repayment terms made it possible for them to actually buy their own shop. It really shows how different tools fit different situations.
That's a fantastic illustration. So, okay, listener, based on all that, what's one thing they could do right now?
Good question. I'd say make a quick list. Jot down maybe the top 3 loan types we just talked about that seem like they might fit your situation.
Just based on first impressions?
Yeah. And for each one, note why it appeals. Is it the low rate potential? The speed? Easier qualification? Then pick one of those lenders or types and just make an initial call or email, ask about their basic requirements.
Just dip a toe in the water.
Exactly. It starts making it real and helps you figure out what's actually feasible.
Great actionable step. Okay, so you've got a sense of the options. Now, how do you actually get the best deal? It's not just about getting a loan, it's getting a good one.
Absolutely critical point. And the message here, loud and clear from pretty much everyone, fundingoptions.com, NerdWallet, you name it, is shop around. Compare offers.
Don't just take the first yes you get.
Never. You need to look at multiple lenders.
Okay, so when you've got a couple of offers,
Yeah.
what are the key things to compare? It's not just the interest rate, is it?
No, definitely not just the rate, though that's obviously huge. You need to look really closely at the required down payment. How much cash do you need up front?
Right.
Then fees. Origination fees, appraisal fees, legal fees. They can add up significantly. And of course, the repayment terms. How long is the loan? Are the payments fixed? Variable? What's the structure?
Lots to juggle. Are there tools to help with that comparison?
Yeah, thankfully. Online comparison sites like NerdWallet or Nav that funding options mentioned can be super helpful. They lay everything out side by side so you can see the differences clearly.
Okay, good to know those exist. Now, stepping back, what are lenders actually looking for when they decide yes or no and what rate to offer?
It boils down to a few core things. Your credit score is a big one. Most want to see, generally 650 or higher. Some prefer 700 plus.
Okay.
Then your business plan. They need to see you've thought things through, that the business makes sense, and crucially, how you're going to repay the loan.
Proof of repayment ability.
Exactly. That means tax returns, bank statements, profit and loss statements showing the actual financial health of your business. And finally, the down payment. Be ready for that, typically somewhere between 10 and 30% of the property price.
Okay, those are the hurdles. Is there anything borrowers can do to maybe strengthen their case, get better terms?
Well, one inherent advantage with commercial real estate loans is the property itself acts as collateral.
Right. Security for the lender.
Exactly. That lowers their risk. And lower risk for them can often mean better rates and terms for you. So the value and quality of the property itself matters.
Makes sense. Now, paperwork. Everyone dreads it. What should people have ready to make the application process less painful?
Being prepared here saves so much time and hassle. Generally, you'll need business and personal tax returns, usually the last couple of years, recent bank statements, both business and personal, that detailed business plan we talked about,
Okay.
information on the property itself, address, price, maybe projected income if it's a rental, and if there are existing tenants, copies of the lease agreements.
Get your ducks in a row beforehand.
Definitely. Having all that gathered makes you look organized and serious, and it just speeds everything up.
You mentioned another example.
Yeah.
About comparing offers.
Right, the gym owner. They were really diligent, got quotes from their bank, looked at SBA lenders, even checked some online options.
And what did they find?
In the end, they went with an SBA 504 loan. It actually took a bit longer to process. The paperwork was more involved. But it offered the lowest interest rate by a noticeable margin. For them, that long-term saving was worth the extra upfront effort. Really highlights that comparison payoff.
It really does. The best deal isn't always the fastest. Okay, actionable takeaway for this part.
Simple but important. Go find your tax returns for the last 2 years, business and personal, and pull up your latest bank statements. Just get them together in one place.
Start building that application packet now.
Exactly. Even if you're not applying tomorrow, having it ready makes the next steps much smoother and gives you a clear picture of your financials.
Excellent practical advice. Okay, final segment. Let's talk pro tips. The savvy borrower stuff. What are those little edges people can get?
Yeah, these are the things that can sometimes make a surprising difference. One big one is building a relationship with a bank before you need the money.
Ah, playing the long game. How does that work?
It's not complicated. Open your business checking account there, maybe a savings account. Get to know the business banker. Ask them questions about commercial loans occasionally, even if you're not ready yet.
Just become a familiar face.
Precisely. When you do come in asking for a significant loan, you're not a stranger. That existing relationship can sometimes translate to slightly better rates, maybe a smoother approval process. It builds trust.
Makes total sense. Another tip that always comes up is credit score. We mentioned it, but it seems crucial.
Absolutely fundamental. Pay your bills on time, every time. Keep your debt levels as low as possible, especially on credit cards. Monitor your score regularly, know what's on your report.
And fix any errors before applying.
Definitely. Dispute any inaccuracies. If your score needs improvement, have a plan to work on it before you start the loan hunt. Good credit is like having a key advantage.
Right. Get your financial house in order first. What about technology? We touched on online lenders, but other ways tech can help.
For sure. Use those online comparison platforms we talked about. They save a ton of legwork. Also, many lenders now offer online pre-qualification tools.
What's the benefit there?
Often, you can get an initial idea of what you might qualify for without it actually dinging your credit score with a hard inquiry. It's a low-risk way to gauge possibilities.
Smart. Okay, any other maybe less obvious angles people should consider?
Yeah, a couple of interesting ones. First, if the property you're buying can generate rental income, maybe it's multi-unit, or you'll lease out part of it, make sure the lender knows that.
How does that help?
That potential income can actually help you qualify, maybe for a larger loan, because it demonstrates an additional source of repayment.
Ah, leveraging the asset itself. Good one. What else?
Don't forget potential tax advantages. The interest you pay on a commercial mortgage is usually a tax-deductible business expense. That can effectively lower the real cost of the loan. Talk to your accountant about that, obviously.
Right. Important disclaimer there, but definitely something to factor in. Any final examples?
Yeah, there was one about someone buying a small strip mall. They used an online loan matching tool, one of those tech advantages, to find a lender with really good rates and fees.
And did they use the rental income angle?
They did. They specifically highlighted the income from the existing tenants in their application, which helped strengthen their case and secure the financing they needed. Shows how these tips can work together.
Really practical stuff. Okay, final actionable takeaway for the whole deep dive. What's one last thing listeners should do?
Check your credit score today. Seriously, go online, use one of the many free services, just know where you stand.
Why is that the starting point?
Because everything else hinges on it to some degree. Knowing your score tells you if you're ready to apply now or if you need to spend some time improving it first. It's step one.
Fantastic. Really concrete advice. Okay,
Oh,
let's
yeah.
try and wrap this all up. Quick summary.
Sure, we covered a lot of ground. Conventional bank loans, the SBA option 7A, and 504 bridge loans for short gaps, hard money for speed or tricky credit, construction loans for building.
Plus the online lenders and even seller financing, a whole menu of options.
Exactly. And the main point is there's no single best one. It totally depends on your business, your timeline, your budget.
So the key is to shop around.
Absolutely. Compare those offers, rates, fees, down payments, terms. Get your paperwork ready early.
And those pro tips. Build bank relationships, keep that credit healthy, use the tech tools available.
Right. And always think about how the loan fits your overall business strategy. It's not just about getting the money.
It's about how that money helps you achieve your bigger goals.
Precisely. Financing is a tool to build the future you want for your business.
So as you think about that next commercial real estate move, remember that. It's more than a transaction, it's a strategic build. Really dig into these options and see how they align with your long-term vision.
Couldn't have said it better myself. That strategic alignment is absolutely key.